Well, hello, good afternoon. My name is Peter Arnold. I'm an economist in EY's team based in London. And I've got a presentation that's basically an extract of the Item Club forecast. So the Item Club is an organisation that EY sponsors, and it provides quarterly forecasts of the UK economy. And last autumn we launched for the first time a forecast for the regional economies of the UK and also 20 cities. And we've got in a little bit of trouble for that because we didn't include Oxford on that list. But you'll be pleased to hear that we're trying to make amends. Firstly, I'm here today, and Harriet's here today to talk about a bit more about the Thames Valley. But when our next round of forecasts come out, Oxford will be on the list. You'll be pleased to know. So you'll have that detail. So I'll very briefly run through the Item Club's view of the world for the UK. I think it's quite interesting that a few years in, or perhaps it's 9 years really since the financial crisis and almost 6 years since the UK economy was out of recession, that we're still talking about a consumer-led recovery. And I think that just captures really the uncertainty and volatility that we still see in global markets, in European markets, and still in the UK itself. That this recovery, the economic growth we've really had since about 2010, 2011, is still quite fragile. So what's the outlook, and what are the headlines then of our forecast? So very much since 2010 and 11, economic growth that we've seen has been led by the consumer. And we'll see that story continue to play out through 2016. But what we're beginning to see is that consumer-led recovery can't last forever. It's supported this year by really the collapse we've seen in commodity prices, most notably in the oil price, but that's beginning to play its way out of the system. And some of the forces that have supported the consumer recovery, very strong employment conditions, will also begin to suffer from what we're calling the headwinds. So we're seeing the new living wage, we're seeing some apprenticeship levies. Some of those fiscal interventions are actually going to undermine some of the recovery we've seen to date. What we're forecasting is that business investment through this year and into 2017 will begin to take some of the slack of economic growth, but critically the referendum on the 23rd of June will be quite an important element of whether that happens or not, because we're unlikely to see the recovery in the export sector. If you remember, when Osborne was first elected, he talked very much about rebalancing the economy away from services and towards manufacturing, and we've not really seen that. And in fact, we've seen the situation in manufacturing, if anything, get worse, and our current account deficit expand. So very much the forecasts are relying on business investment beginning to pick up, and therefore the referendum becomes quite critical for whether that happens or not. So I'll quickly sail through what we've seen in terms of the consumer recovery. So the consumer recovery, we've seen really since 2011 the savings ratio fall down quite dramatically. But this hasn't also been accompanied by consumers using lots of debt. So we can also see the household debt-to-income ratio fell pretty quickly post the crisis as consumers began to tighten their belts and began to pay off mortgages. That's flattened out, so consumers haven't increased their debt, but we are seeing the savings ratio drop. So we're actually seeing that some of the spending has been funded through people wearing down their savings rather than borrowing money, which is marginally better than borrowing money. And what we're also beginning to see is that we look at mortgage lending, which is on the right-hand side. You can see that really peaked before the financial crisis and was a big driver of the financial crisis. It crashed as we saw the hit in recession in 2009. And while it's recovered, it's certainly not recovered the growth in housing investment. So the housing market has recovered, but that's not been supported by a growth in mortgage lending. What's actually happened is people have taken advantage of lower interest rates, and they've taken their investments in equities and in other financial instruments, and they put that into housing. So yes, we've seen this growth and recovery in the housing market. But what we've seen is actually there's net investment into housing. People have been investing into housing, paying off their mortgage or going into buy-to-let rather than putting their money in the stock market. We move on. The other aspect of the recovery has been really this reliance on the labour market. So the recovery has been very jobs-rich. Employment has grown incredibly strongly since 2010. We didn't see the mass unemployment that we saw in earlier recessions in the 90s and indeed in the early 80s. We actually saw unemployment peaked at around 8% and has recovered very strongly since then. And that's really been driven by the reforms that were made in the 80s and 90s around labour market flexibility. It's far easier to hire and fire in the UK, and with the uncertainty around the economy, we found that businesses have tended to bring in more labour rather than invest in capital. So we have this productivity puzzle that people have talked about, which is really just reflects the fact that rather than investing in equipment, we've invested in labour and bring people in. And that growth in employment and very low unemployment has supported the recovery in the economy. So some of these jobs are quite low wage, but it's better to be on a low wage than be unemployed, and that's supported the recovery. But as we move into 2006 and through into 2017, we think that story has played itself out. There's very little slack left in the labour market, and other factors need to intervene to support the recovery. And as a result, we're forecasting that consumption and unemployment, having fallen quite dramatically and consumption being pretty strong, we'll begin to see them normalise and stabilise throughout the end of the decade as that consumer story has run its course. We move to external trade. Now, the right-hand chart shows you UK exports and world trade, and you can see there's been a pretty strong correlation between UK exports and world trade, as you might expect. But importantly, world trade, or growth in world trade, has not recovered to levels that we saw pre the financial crisis, where it was growing much more sort of 8% a year. We're seeing much closer to around 5% a year. And that has an implication for the recovery in the export sector, in that effectively we've not been able to grow our export markets, our manufacturing capability as much as we'd hoped to, and instead the reverse has happened. The UK economy, because it's outperformed the rest of Europe, has instead been sucking in imports. And so what we've seen on this chart, we can see those grey boxes towards the end. That's the contribution of trade to economic growth in the UK, and we can see it's been negative. It's been lagging. It's been slowing down growth as a consequence of that burgeoning balance of payments deficit. Business confidence. Now, business confidence had been pretty buoyant through 2014, 2015. It's been beginning to decline, and the same with investment. You see, we had pretty good recovery through 2014 and 15. And investment, as we got through to the back end of 2015 and the beginning of this year, again, both confidence and investments are beginning to slide. Now, we think that's largely a temporary thing. We think it's largely as a consequence of nervousness around the outcome of the referendum, and we'd expect that following a vote to remain in the EU, we'd like to see a bounce back, both in confidence and importantly in business investment, which would support growth through to 2017. And I think that then becomes the critical point of the assumption that our forecasts are based on. Our forecasts are based on very much on a Remain vote. EY has no opinion on it. We don't express a preference either way, but these assumptions are based on that Remain vote happening. And it'd be interesting to understand what happens in the event of an exit vote, and us, EY alongside Oxford, have looked into that and done some scenario analysis on that, and particularly looked at some of the key parameters. So we've looked at trade and trade relations, not just with Europe, but with the rest of the world. We've looked at migration, different types of regulation, and then the impact of fiscal and monetary policy to see how we would see that impacting, the outcome post the referendum. Before you do that, it's important to understand what kind of policy response we're likely to see post any referendum. And I think the Exeters broadly fit into two camps, if you like. There's a populist response and a liberal response. And if you know your UKIP politicians, you know that's the kind of Faragian position, and that's more the Carswell position. And there's those two camps, those exit camps are really very much the populist response. It's reduce immigration, it's put up the trade barriers, it's the Little Englander caricature, versus the much more liberal, if we leave the straitjacket of the European Union, if we abolish the regulations that hold us back, we're free to trade with the rest of the world and have a very liberal approach to how we manage our economy. So those two schools of thought. And actually the impact of an exit vote therefore depends on which of those really holds sway in the event of any negotiations or in the event of political power. And therefore, what Oxford Economics have done is they've produced a range of forecasts that are based on combinations of scenarios for the types of trade deals we can agree with the European Union, indeed the rest of the world, post-exit, but also the mindset of the policy makers around whether they're leaning towards that liberal point of view or whether they're leaning towards a more populist point of view. Now, what Oxford says is actually, regardless of the various combinations, there's very little upside in in an exit vote for the UK economy. So this is a forecast of the impact on UK GDP by 2030 as a consequence of leaving the European Union. And you can see that under the most pessimistic view, which is very populist and actually quite limited in the grounds we make on trade, potentially about GDP would be around 4% lower in 2030 than it would otherwise have been. If you look to the right-hand side of the chart under a more liberal, very liberal approach to both policy and to trade, actually it's, there's very little upside, there's probably no downside. And I think this is probably the context to think about Brexit, is to think about that balance between a liberal approach and a populist approach. I'll make one last point, which is worth noting that the GDP is much lower than, say, GDP per head, because while restrictions on immigration will affect the ability for the economy to grow, actually lower immigration with slightly lower economic growth can result in better GDP per head. And so under the most liberal view of the world, actually you get an increase in GDP per head even if total GDP is fallen. So that's probably something else to think about as well. So before I hand over to Harriet, I'll just put up my last slide. And this shows you our outlook for how we see the UK economy evolving over the next 5 years. And you can see 2014, very good year. 2016 is going to look a little bit more like 2015, so about 2.3%. But importantly, consumer spending is beginning to decline, and we're hoping that fixed investment recovers off the back of a Remain vote in 2016 to restore a bit of confidence to the system.
Thank you, Peter.
Okay, thank you.